is a critical chart that suggests our economy might be collapsing actively, and the suits on Wall Street are deathly afraid about you finding out about these charts. Starting with this one right here. You've got to know about the details of exactly what's going on here because it's going to make sense of everything for you. This might be the most important video we make on the channel this year. Hey everyone, Meet Kevin here. If you're wondering how to combine all of the pain that happened with not only Microsoft getting shellacked by 10% today, which is something you would really only find during like a COVID crash or like a Great Recession style crash. Microsoft, massive company, 10% decline. Taking the entire software stack with it, mind you. You look at ServiceNow or Snowflake or really any other kind of software company today, absolute shellacking. What happened? And why are these companies getting beat up? What does it have to do with this chart? And how does all of it link together with private credit and, ironically, a company like Facebook, Meta, going up 10% today? Well, this chart explains all of it, and we're going to link everything together and break it down for you in this video. So subscribe to the channel, buckle up, and let's get into it. First, we have to start with the baseline of what has been funding the core of our economic growth over the last few years. We know that the normal everyday consumer isn't benefiting from the best economic data ever, as Donald Trump tells us. Those are the headline numbers that are really boosted by artificial intelligence, and a lot of that spending is driven by private credit. Private credit, we know, has started to roll over, but so far, Wall Street banks are telling us, guys, don't worry. These are just individual little frauds. It's all fine. And maybe that's true. Maybe everything is fine. I mean, quick recap. The same day Charlie Kirk died, it's terrible. We ended up having Tricolor collapse. Oh, but they were spreadsheet fraudsters. 3 weeks after that, First Brands, an auto provider of things like windshield wipers and auto parts, collapsed just a few weeks later. And then now they're indicting the founder, as of today, for fraud. So I guess maybe that was just fraud too. And then I guess the collapse of Sonder Homes or Spirit or Renovo Home Loans or many other companies, including BlackRock's very own private credit fund that got written down 19%, or, I don't know, maybe Apollo writing down $170 million of private credit to zero literally 2 days ago. Maybe all of that is just idiosyncratic, which, is a really fancy way of saying, those are just unique to their own little companies. But you can't really say idiosyncratic and believe it without thinking idiot if you believe it. There's something else going on here. And so when PIMCO gives us a warning like this, a firm that manages $2.3 trillion, $2.3 trillion, this is like a JP Morgan size of company. When they give us a warning and start saying things like, hey, we might actually have serious problems here that people aren't paying attention to, it's oftentimes not just time to start paying attention, but often already too late. Because a lot of these big firms, they don't want to say things are bad because then things get worse. But they do eventually want to tell you things are bad because that way they can tell you they told you so. It's CYA, so they get sued less. Anyway, maybe I'm just jaded. Call me Kevin, that jaded guy on YouTube. Anyway, look at this. Private credit's hidden hazards. PIMCO president warns investors are turning a blind eye to mounting risks as problems from loans from the zero rate era come due. This is really a fancy way of saying there's refinancing risk, and a lot of these private credit funds have been throwing money at artificial intelligence. That's what we're about to hit. That's why there's a warning about sector concentration. It's artificial intelligence. And then, of course, we get limited disclosure, limited mark-to-markets, right? We saw Blue Owl is seeing this exodus of investors. Blue Owl is a company that's throwing money at Meta's data centers for them. They're taking on the debt risk, financing these data centers and artificial intelligence expansions, and people are fleeing them. Multiple times a day, I feel like I'm seeing articles about Blue Owl investors trying to bail out to whatever limit they can get out, and that they're seeing the largest exodus that we have seen since really the creation of private credit in this last boom since the great financial crisis. It's a problem. But what does all of that have to do with those original charts? That first blue chart I showed you, showing this sort of peaking out line. Well, frankly, everything. Here it is. AI, or artificial intelligence adoption rates, have started to flatten out across all firm sizes. So this on the left side here, on the y-axis, shows you the percentage of new firms entering into artificial intelligence. So in other words, if you're a firm and you're like, all right, boys and girls, it's finally time to pick up, tighten our boots or tighten the belts a little bit and strap the boots on and adopt this AI thing. Companies were growing. We saw a lot of this since the GPT moment, and more companies are like, all right, it's finally time to adopt AI. That period of time has now started to shrink or see fewer companies making those decisions. This means the aggregate or total number of companies has started to flatline because you're getting fewer companies coming in saying we need to adopt AI. So if you take a look at this, artificial intelligence adoption rates have started to flatten out across all firm sizes. What you find is really an S-curve here. GPT moment, the early easy adopters, kind of like the first people who adopt full self-driving, like me in 2017 making YouTube videos. Guys, I'm on autopilot on the highway. This is the coolest thing since sliced bread. Leave me a comment if you were watching my videos back then. But anyway, now you go through this era of early adopters to euphoria, where a lot of people are adopting, and then you get the slowdown period, where you got half of companies to adopt, and the other half are like, AI hallucinates too much, or AI sucks anyway. We don't need to use that crap anyway, right? Those are the hard ones to get. That's like getting grandpa to get into a self-driving car, okay? It's going to take a lot more effort to get these folks to adopt artificial intelligence. This is a massive problem because all of a sudden when artificial intelligence adoption rates flatten out, what does it mean for the entire sector of AI, which is boosting our entire economy, which is boosting private credit? Well, it potentially means that AI investment might start petering out. And if AI investment starts looking like it's going to peter out, then private credit is going to start petering out. And if private credit starts petering out, then AI investment continues to peter out. It's a doom loop. And it doesn't matter which one came first, the chicken or the egg in this case, private credit petering out or AI petering out. Now, you could have a private credit crisis that starts making funding harder for AI, even though we're still trying to boom in AI, and you still go down because it's a doom loop. When one fails, private credit or AI, doesn't matter which one starts, when one starts faltering, they both start faltering. And that's when you start seeing what I call bail-ins from companies like NVIDIA, which you're going to see in this video, companies to OpenAI or xAI, which you're also going to see in this video. Then you start really scratching your head going, uh-oh, what's going on here? So it's not just these charts, though. Take a look at this. Those were firm-wide charts. AI adoption, though, for generative artificial intelligence work, at work essentially, right, has flatlined. This chart goes all the way back to August of 2024. And you can see the lines for share using Gen AI, use Gen AI last week, use Gen AI every day last week, have flatlined. So it's not like the people who were using it just once a week all of a sudden are using it every day last week. Or the people who are using Gen AI are all of a sudden also using it last week. We're not really seeing a movement there. We're seeing flatlining. Flatlining is bad. Kind of like you go into a hospital, they're like, oh, flatlining, crash cart, he's crashing. You get the crash cart come in, the defibrillator comes, clear. Kind of try to, get it up again, okay? We're trying to, sometimes people have a hard time, or industries have a hard time getting it up, and then we got to help them out a little bit, and then hopefully everything's fine. or it's a sign of a larger problem. And that's the problem here is if you go to the very next slide, you can see how has your firm's use of artificial intelligence affected your firm? And well, you could see that the vast majority of companies here, about 69% report no change. Otherwise, you've got really nominal responses. You've got just as many people saying that artificial intelligence has essentially combined here, either decreased their productivity by 1 to 5% or more than 5%. If you combine those together, you're roughly equaling the increase of more than 5% group over here. And then, of course, you do have this increase of 1 to 5%, but, reporting companies, that's really only somewhere between 15 to 25%. So, in other words, this bucket right here on net is the bucket that's really driving artificial intelligence. Otherwise, a lot of people are reporting, I don't know, it helps a little bit, but is it really at that level where it's doing as much as we're being promised? Maybe not. Now, I personally think we're, myself, my real estate startup, we're somewhere over here in this high value add task, and we're seeing massive productivity. But we also study and work artificial intelligence on a daily basis. I mean, after all, we're a real estate artificial intelligence software as a service startup. You can learn more about that at househack.com. We're Reinvest Same Company. I just invested another $1 million of my personal money on my birthday just yesterday into my own real estate intelligence, software intelligence company, because we're looking going, wow, we have a really bright future. That's our opinion, right? This isn't a solicitation for you. If you want to invest in that, go to househack.com, but read the offering circular. This is just a way of saying, I'm really optimistic about what we're seeing with artificial intelligence. But that's not the point of this video. See, I can be really optimistic about what we're doing with artificial intelligence, but that doesn't matter for private credit or all the companies taking on debt. We don't take on debt. We don't care. But all the other companies taking on debt and relying on private credit, they need everyone to be like, oh my gosh, I gotta have more AI. And it's like, you go to Cold Stone, you're like, I gotta have it. That's what companies like Microsoft rely on. And in a moment, you're going to see the difference between Microsoft and artificial intelligence and Meta. And this is actually a really critical distinction that could also help your investing future. So pay attention to this distinction because it's going to be huge. Now, something else that could also help your investing future is, well, this. This is an exact print up of our alpha report that I sent out this morning, about 30 minutes before the market opened up. And I want to show you this because you can learn something from this alpha report, and then we're going to show you actual statistics. Just know if you want to get this alpha report yourself, I'm making a very special, because of this video and the shellacking that just happened, extension of our coupon code BDAY at meetkevin.com to Friday at 11:59 p.m. Yesterday was my birthday. We had a shellacking in markets today as I went on vacation. So we're going to extend that coupon code to 11:59 p.m. And then there's going to be a big price increase on the product. So if you want to get lifetime access for these alpha reports I send every day the market is open, check it out at meetkevin.com. But let's take a look at the insights on the alpha report this morning, exactly the way I posted it. There it is, 1/29/2026 alpha report. I sent this at about 6 a.m. this morning. I wrote yesterday, bleed out towards Powell. Nailed it. Hopefully you were able to stay safe because we talked about all that yesterday. It was just a sort of a quick recap. Like, what did we get right? What did we get wrong from the day before? Critical today, I wrote. The more I study Microsoft, the more pissed I get. $7 billion of their net income came from OpenAI as a liquidation value adjustment. Over 40% of their RPOs, we'll talk about that in just a moment, are just from OpenAI. The more exposure companies have to OpenAI, the riskier they are. Meta does not have this issue, I wrote. And so I wrote, therefore, I also said, by the way, Tesla's gutting itself of what it's done well to fund the unknown, and I had some comments about this. So I wrote that my opinion today was the move was the following. Watch the first 5 to 15 minutes. If Microsoft tanks in the first 5 minutes, which has more risk than Tesla, we're probably going down to 428, which if you look at the chart is exactly what happened today. I forecast that this will, though, lead Microsoft to go down to under $400 by mid-February, giving away some alpha here. I also wrote in this case, Oracle has more downside and the upside on chip plays stays limited, which Oracle sold off as much as 5 to 6% intraday. And then all of a sudden the chip plays, they were pretty flat and stable, but again, upside capped, just like what we wrote. And so my warning was, if institutions are selling Microsoft, we're bearish the Qs today. We were green when I wrote this on the Qs, when I wrote this report, and we tanked. I wrote that Tesla, if the Qs go down, might follow Microsoft down. And it did. I do also write that this is not trying to be bearish on the entire economy. If OpenAI craters, that's bad. We're far from that at this point, but we've got to be watchful. And the watchfulness is what I want to show you in this video, because after this alpha report released, we got these charts from Apollo Credit. Now, why is that interesting? Apollo Credit is literally the firm that just wrote down over $100 million of private credit losses, writing over $100 million down to zero because of artificial intelligence and private credit. But that's interesting because they're also the ones putting together these charts, well, some of them, and this data, which then makes me wonder, maybe they're trying to secretly let us onto something. So here's another chart from Apollo. Are productivity gains flattening? Percent of hours saved as a share of hours worked in the previous week. In November of 2024, we thought we were saving about 1.4 hours per week. Then we went to 1.6. Then we went to 1.8. Now, 1.7. The gains have stopped, and we're now actively in reversal. Now, this is survey data, so it could be unreliable, but Microsoft's data is actually proving the point. In fact, we reported this on Microsoft in the fourth quarter, that Microsoft had some engineers leak that Microsoft was starting to lower sales targets for some of their generic artificial intelligence agents products. And see, if generic artificial intelligence agents were really capable of replacing enterprise software, that would be really great for Microsoft. But they had to lower their quotas because they can't get people to stick. This was an early warning sign that there were problems at Microsoft. Another problem about the entire artificial intelligence stack, unfortunately, is that companies like Microsoft and Meta keep blowing more and more money on artificial intelligence. Facebook, for example, Meta, just announced that they're spending 13% more in CapEx in 2026 for artificial intelligence than we thought they were going to. We thought they were going to spend about $110 billion this year. They're actually going to spend somewhere between, well, midpoint, somewhere around $125 billion. And there's an upside part to that range too, which is wild. But if you look at this chart, you can see the CapEx as a percentage of GDP today is actually way higher, the yellow bar, than what we saw in the 2000 dot-com bubble of telecom companies. Oops. It means the spending we're doing is even more drunk and loony than compared to the dot-com bubble, which is somewhat scary. So let's understand why, Kevin, is Meta doing so well, Microsoft doing so poorly, and what does all this have to do with OpenAI and XAI? Well, here you go. Microsoft told us the following. Microsoft in their earnings told us that gaming, search, and advertisements were soft. Those are core business items that aren't related to artificial intelligence. Now, Copilot seat growth was great, up 160% year over year. But the problem is, remember the charts earlier where we see 69, 67-ish% of people aren't seeing productivity from artificial intelligence at work? That's not good for more Copilot adoption, especially as people think that companies like Moltbot, formerly Claudebot, or Anthropic, and their actual Claude product, are kind of kicking Copilot's butt. You open up Claude.com now, they try to give you use Claude in Excel, basically saying, don't pay Microsoft, pay us instead. Now, that could be idiosyncratic, or there are risks to the entire industry. And you might have a feeling of where I'm going here. But remember this for a moment. Microsoft is a little exposed. When I say a little, I should be saying a lot. Because Copilot requires that users sign up for the product and renew the product. Microsoft signs a lot of 3-year deals, which means we're about to hit a massive renewal cycle for enterprise Copilot adoption in 2026 and 2027, which is 3 years after 2023 GPT release and integration into Copilot, and 2024 euphoric ramp. And if companies aren't reporting productivity gains from artificial intelligence, we have a really big problem, especially compared to other businesses that don't rely on that kind of adoption. Now, we'll talk Meta, but before we do, what's the nail in the coffin for Microsoft when it comes to artificial intelligence potentially not being as productive as researchers are finding for the vast majority of people? Again, I find AI productive, maybe you do as well, but maybe we're unique and we forget that. Who knows? But take a look at this. Microsoft tells us they have $625 billion of remaining performance obligations. Of those, 40% are OpenAI. $250 billion of revenue Microsoft is telling us they're going to get is coming directly from OpenAI. Only $30 billion is coming from Anthropic and $345 billion is coming from other Azure commitments. This is actually a real problem for Microsoft, because Microsoft is telling us, oh, well, the reason things slow down is because we just don't have a place to put all these server chips. And because we're not able to put all these server chips everywhere, well, I mean, that's why, we can't plug them in. That's why Azure is growing slower. And if we actually had a place to put all these chips, we'd be able to grow quicker. So we're just running out of room to put all the chips. Right. But your RPO concentration used to be massively diversified to thousands of different countries or companies around the world. Now, 40% is in the hands of just one company, OpenAI. Now, why is that a problem? Well, it's a problem because OpenAI, we know this, we've been covering this on the channel regularly. OpenAI burns money hand over fist. OpenAI is a company that isn't expected to actually generate a profit, likely until 2030, at least according to some researchers. Some say, oh no, they'll be profitable sooner. They'll be profitable maybe in 2029, but certainly not until then. Okay. Either way, this is problematic because it means that OpenAI needs money to actually be able to pay Microsoft. But that cycle creates issues of, well, perpetual hopes that AI would actually be useful for people. And as a result, to try to keep these hopes going, we're seeing our first bail-in. Take a look on screen here. We are seeing current talks of a $100 billion mega round, the biggest AI fundraise in history for OpenAI. Amazon in talks to invest up to $50 billion into OpenAI, SoftBank up to $30 billion, NVIDIA up to $30 billion, Microsoft somewhere around $10 billion in addition, to pump up OpenAI to give them cash to keep the cycle of spending going, even though we're seeing productivity slow down. Now, this is somewhat problematic because the same thing is happening at companies that provide services to OpenAI, like CoreWeave. Think about this for a moment. OpenAI is burning money like crazy, not seeing the enhancements we're hoping to see at Microsoft, so both of them are suffering. And so it's no surprise that a data center company or a neo cloud like CoreWeave is also seeing problems. CoreWeave is a company that saw its stock drop over 64% at a low in December of 2025. Now, it's since recovered a little bit, but you should ask yourself, why did CoreWeave recover a little bit? Watch this. CoreWeave recovered in December because of the following. In January, actually. On December 31st, CoreWeave is on fumes for cash. I wrote on X. You can follow me there at RealMeKevin or on Instagram at MeKevin. I post there pretty much daily. Take a look at this. CoreWeave is on fumes for cash and announces new loan terms that allow unlimited equity cures for any failure to satisfy debt service. In other words, CoreWeave is so badly running out of money trying to provide service to companies like OpenAI so they can keep paying Microsoft that they're begging the lenders to give them exceptions. And they're basically saying, hey, if we could get somebody to bail us out or bail us in by investing more money into us, is it okay if we screw up some of our loan terms? And the banks are like, well, if we say no, we're screwed anyway. So yeah, I guess it's okay. And so what happens just 3.5 weeks later? On January 26th, NVIDIA invests $2 billion into CoreWeave at $87 per share to prop up CoreWeave. Nothing to see here. Just like the private credit issues. It's all idiosyncratic. It's all just these individual companies. They had little hiccups. CoreWeave had trouble pouring concrete in Texas because, it got a little cold and a little rainy. So they didn't want to pour the concrete. Come on. And if they poured the concrete, then Microsoft could have plugged in the GPUs, and then NVIDIA wouldn't have as many GPUs in inventory, and it would all be fine. But see, that's what people, much like a perpetual motion machine, get wrong about artificial intelligence. Take a look on screen here. Artificial intelligence is this promise of perpetual motion, or at least the investments that we're seeing. This, hey, NVIDIA is going to generate chips. Microsoft is going to plug them in. OpenAI is going to do the inference for us and the training for us. And CoreWeave is going to help hold some of these chips. Whatever, right? They all have their different services and purposes that they serve. Azure over at Microsoft, or CoreWeave providing the leasing of the GPUs, or the renting out, or the sale of, whatever, right? The idea is that as long as the money keeps flowing, it's fine. But the thing that people forget in this infinite money loop is perpetual motion doesn't exist. If you create a loop of water, let's say, and you're like, oh, I can have energy forever, I've solved perpetual motion. Everybody's thought about that as a kid. Like, why wouldn't this work? Well, it's because there's this thing called friction. Friction kills motion. NVIDIA throws cash at companies like OpenAI that are burning. I mean, this here says $5 billion per year. That's a dated number. They're currently probably burning somewhere between $19 to $48 billion per year. But we don't have that full color because, well, it's a private company, and that's hidden. That's a lack of disclosure, like what PIMCO warned about. Microsoft isn't seeing a lot of ROI for like 67% of their users on Copilot. At least that's what firms are saying per Apollo. And CoreWeave can't even pay their frickin' debts, so they're breaching their covenants. All this stuff creates cash burn, lower adoption, funding stress, and loss. Eventually, the perpetual motion machine stops. And why? Because friction always wins. Circular funding schemes don't work because in the long term, cash burn always takes over and bankruptcy ensues. It's not good. The only question is, when does the music stop, right? Like I wrote in my alpha report. Remember, you can get that at meetkevin.com. Use that extension code. When does it stop? Or where do you go in the meantime? Do you just say, who cares? Let's go somewhere else in the meantime. We're going to talk about that somewhere else in Meta and some other stocks in just a moment. But the fact that you have to remember is this isn't just OpenAI. This is also Elon Musk's XAI. Take a look at what I call virus takeover stage 1. XAI has drained capital from all of these different companies. BlackRock, Fidelity, they've taken the Twitter revenue, Cisco, Valor, A16, Andreessen Horowitz, Tesla, they've taken $2 billion from. They've taken money from SpaceX. They've taken money from NVIDIA. They've taken money from a lot of different companies to fund Elon Musk's version of GPT. That's stage 1, is suck in all this money. Because just like OpenAI, they got to keep sucking in money to keep this cycle going. Got to use nice words here. But what comes after this sort of feeding frenzy where, they get 2 billion, then 20 billion, then 10, then 6, then 6, now, or originally 135, I read this upside down, $135 million originally, then 6, then 10, then 20, then 2 from Tesla, right? All of this, SpaceX should frankly be on here as well. All of this money flowing into XAI for a money-losing business to keep artificial intelligence propped up so Elon can win his personal vendetta against Sam Altman. But what happens next? Well, this tells you how bad the bail-in is. Not only do we have $100 billion potentially getting raised to bail in OpenAI, where existing investors are throwing in more money going, oh no, oh crap, we need to save this and keep the cycle going. Elon's doing the same thing. But Elon hasn't made as many friends as Sam Altman. So Elon gets a bail-in from himself. Elon at XAI calls up Elon at Tesla. Hey, yo, I need $2 billion. How are we going to do it? More shareholders voted no on acquiring XAI shares if we include the abstentions. Well, let's just redefine it. Let's not count the abstentions as no's, and let's just count the yes votes, and we'll call it a pact. Can I get my $2 billion now? Yeah, sure. Here's the $2 billion. So Elon negotiates with himself to get money from Tesla, even though the normal way the Tesla board decides, when you count abstentions, it's counted as a no, where we don't want to invest in XAI. That's the normal way. Even though that normal way says no, Tesla's not going to invest in XAI. Now you got Elon going, oh, guys, well, since the vast majority of you wanted to invest in XAI, we're going to do it because he needs the money. But that's not enough. So then Elon's got to pick up the phone again and go, hey, Elon at SpaceX. Can we merge into SpaceX? Because you're going to IPO, and that's going to give us public liquidity for this massive money-losing business. So what do we have here? Stage 2, the infection spreads. The parasite breaches the crown jewel. XAI, the money-destroying virus, gets into SpaceX. SpaceX, a company that generates profitability from Starlink, over $20 billion in government contracts. You've got billions of dollars in space launches, revenue that's exploded from some of their older levels, including their valuation that's exploded. I'm a venture capital investor in SpaceX. Our venture capital firm is probably up 3 to 4x on our SpaceX investment. So don't get me wrong. I love SpaceX, but I don't like this money-destroying virus potentially coming in to screw up the SpaceX IPO. But that's what's happening. Why? Because if it doesn't happen, the virus is going to self-destruct. It needs another host to suck money from. So why not attach itself to a business that has been built for 23 years and generated over $800 billion of market cap, potentially as much as $1.5 trillion? Why not attach yourself and leech from that? Well, that's exactly what Elon is doing. And so this is where, when we broadly look at what's going on in the artificial intelligence space, we should be really concerned. And in my opinion, a lot of companies with exposure to artificial intelligence seats, this would be like a co-pilot, where you've got essentially a wrapper around some kind of AI product, are potentially facing really big renewal risks. Now, I do think a lot of babies are getting taken out with the bathwater here. Like, ServiceNow's numbers are pretty good. UiPath is a fantastic example of a company that's getting absolutely battered because of this idea that, any company that sells seats, even like an Adobe, is going to get destroyed by artificial intelligence. UiPath is an interesting one. I mean, just look on screen here. UiPath, in my opinion, has this unique moat because it's something that like a Moltbot can't compete with, because they provide to about 900 enterprise customers governance, audit trails, compliance, reliability. They're used in healthcare, HIPAA regulations, financial services, government, insurance, consulting. Got to have accuracy. So I think UiPath is actually a really cheap play, but it's probably at risk of more downside because, well, frankly, right now everybody's selling everything software. And so that brings us to Meta. Is Meta potentially a better play in this environment? And why is Meta doing so well? Well, as we've been sort of hinting from the beginning of the video, Meta is very different from Microsoft. Look at this. Meta, according to JP Morgan, is likely to see their revenue grow 30%. And what's unique about Meta's revenue is they're not actively reliant on you renewing your Copilot subscription. Meta makes money from you enjoying content on Instagram or Facebook, Reels, Stories, whatever. The more they can convert you to buy stuff by feeding you what you want to see, using the benefits of artificial intelligence, by feeding you the right stories, the right posts to keep you on the platform, by feeding you the right ads to convert you more likely, which is exactly what's happening. Their conversion rates at different parts of the business are all skyrocketing, anywhere on the low side of 3% increases in conversion rates year over year to as high as 24% increases in conversion rates. Watch time year over year is up 30% at Meta. This is a business that has figured out how to keep you glued on the platform, whether it's Instagram or Facebook. The same's probably said about TikTok, though. you got some questions there. I guess now we're censoring Epstein and everything related to Epstein because that doesn't align with the Trump administration. But whatever. Trump administration also wants everybody's retirement account to throw money into private credit because the suits on Wall Street need some money. Anyway, knock on wood, we don't never get censored over here on YouTube, so we can keep freely talking about these sort of topics. But Meta is an interesting one because AI enhances Meta's existing revenue without requiring seats or subscriptions or new adoption. They just keep showing stuff to people on that are vertically scrolling and buying stuff, which is basically every single consumer in America. Users don't have to learn artificial intelligence or how to use Copilot or how to use all the features in GPT. It doesn't matter. There's no renewal risk either because advertisers pay for results, not seats. And there's really just this transactional, hey, people are getting impressions and hopefully they're clicking and buying our product. It's a totally different business. And for, well, frankly, months, I've been saying that Meta looks pretty dang cheap. And so to me, it's not a horrible surprise that Meta had this very nice skyrocket. And it's a stock that we've been talking about quite a while on the channel and in the course member live streams. But all of this together creates a really interesting bottom line. Economically, aggregate data tells us the economy is doing fine. But if private credit continues to slow down, then the whole AI Ponzi flows, it all flows down. It all cycles down into the toilet. We're going to keep getting little adrenaline shots. That's what we're getting right now, okay? This $100 billion to OpenAI, adrenaline shot. The money to XAI that Tesla gave them, is going to potentially come from the IPO, little adrenaline shots. But those adrenaline shots won't last forever. And that's exactly why you've got to be cautious in this market. Educate yourself on a daily basis, diversify, increase cash. Ignore the people who are like, oh, but Kevin, the dollar is losing value. If you have cash, you're losing value. No. That's foreign exchange. That matters if you go, buy stuff from Europe or you're going to go fly to Europe on a vacation. Otherwise, cash is a call option on everything. And if your cash is yielding 3, 4, 5% or whatever, then you have optionality above the rate of inflation anyway. So it's really less of a problem. Anyway, if you like this presentation, consider what we do over at meetkevin.com. Join that alpha report. We've extended that to 11:59 tomorrow. If you want, you could bundle it up with the real estate artificial intelligence that we do over at househack.com. I'm going to go enjoy my vacation, and hopefully tomorrow we get a little bit of a rebound in markets so cooler heads can prevail. Otherwise, the carry trade unwind is about to accelerate.